as investors need to realize, even though the price of oil is almost the same as it was in 2004, and in 2004 the price of silver was $6.67, they were producing silver at 13 ounces a ton in 2005. Now it's down, first 3 quarters of this year, it's down to 7.4. It's almost a 50% decline. So they have to move more ore to produce the same silver. This is very expensive.
Prepare for shock and awe. Gold, silver, copper, and zinc. This 30-cent a share company could be looking at life-changing gains. Even Resource Capital Inc., a $1 billion private equity fund made up of expert mining analysts and investors, just quietly took an 18% stake in the company. Learn more at crushthestreet.com/hardassets.
Hello, everyone, and welcome into crushthestreet.com. We got a returning guest today. His name is Steve St. Angelo. He's of srsroccoreport.com. He brings excellent analysis to the table, and each time I talk to him, I learn something new. And we got a lot of important issues to discuss today. Obviously, the Fed rate hike decision was extremely important. That actually happened a couple hours ago. We're going to talk about precious metals and the economy. And this is the one guy who's been making the case that collapsing oil will devastate the economy. And we're right in the middle of a mess at the moment with oil crashing below $40 a barrel. And it's a great time to talk to Steve. Steve, thanks so much for joining me today.
Ken, it's a pleasure to be here to talk to you.
Steve, we need to clear the air up and wrap our minds around a concept that is just rather a conundrum for the economy. We've talked about how the economy needs high oil prices to run cities like Los Angeles, New York, and Dallas. But at high oil prices, the consumers and businesses are getting crushed because they can't afford high energy prices. What have you come across to shed some light on this dynamic?
Before I get into that, let's throw out a few data points here. The 3 biggest oil companies in the U.S., ExxonMobil, ConocoPhillips, and Chevron Texaco, Chevron now. In 2012, their combined free cash flow was $9.2 billion. 2013, minus $13 billion. 2014, minus $15 billion. These are the top 3. Now, actually, ExxonMobil had the highest amount of free cash flow, and they're still positive, but they're only like 0.4 billion positive in 2014. The worst were Chevron and ConocoPhillips. But what happened in 2013, the major oil companies realized when we had prices up above 100 for 3 years, 2011, 12, and 13, they realized they need 120 to bring on more oil. But what happened is in 2013, free cash flow was negative, or a break even for ExxonMobil. So the shareholders told the major oil companies, stop spending money if you're not going to make money. So they started cutting back on future projects. This is when oil was 100, 110. Well, now that the price of oil has fallen considerably, it's destroying the shale gas industry and oil, shale oil and shale gas. Now, let me tell you the big shale players, Pioneer, EOG, and Continental. Their negative free cash flow for the first half of 2014 was negative $0.8 billion. The first half of this year, 2015, it's increased to negative $2.8 billion. We're just seeing more red. Basically, the energy companies can no longer make free cash flow. It's so expensive to bring this oil on. And what I just came to realization, and this is what you asked me about, Kenneth, was that I thought we needed 70, 80 or more. That's what the oil companies needed, at least to keep things going for a while. But below 70, 80, we start seeing the destruction of the shale companies as well as the other major companies. Well, according to work by Gail Tuverberg at Our Future World, she has a great chart that shows that it wasn't 70 or 80. It's 2025. In the 1970s, when the price of oil really shot up and inflated dollars, we started adding a lot of debt in the world. And so what we did is we added more debt. Basically, wages did not keep up with expensive energy that would actually flow and be inflation everywhere in the market. And so we had to add more debt. And that's what we've done since 1970, in the 1970s. We actually can't afford $40 or $50 oil unless you add debt. And so now this is the problem. We have all this debt, and we can't really finance this debt at $18.5 trillion US. So that's why interest rates have come down. So this is the conundrum we're in. We can't afford high oil prices, and the market, the oil companies are gutted at low oil prices, and then growth stops. And without growth, you can't keep the greatest financial Ponzi scheme in history continuing.
Steve, at the moment, I mean, why are we seeing such a depression in oil? Is it just the glut coming from OPEC, or the slowdown in the economy? And I guess my question is, who is going to fall out first? Is it OPEC or the U.S.?
Well, that's a good question. We do know, and the reason why the oil prices hasn't fallen. Now, if we go back and look at the data by the EIA, which is the U.S. Energy Administration, or the International Energy Agency, which is they look at oil production figures, we had basically more demand than supply in 2013. This started to change in the beginning of 2014. And increased significantly over these past, let's say, 3 quarters. Now, we had a real big build in the inventories this past, actually today, which dropped the price of oil. So oil has fell almost $2 today to 35. So that was the problem. The price of oil has been falling because there's more supply than demand. And you would say, well, how could that happen in a peak oil environment? Well, it's because this oil came online, Kenneth, because of debt. Now, the problem is, who goes first? That's a good question, because we know the shale companies have been getting a lot of capital, and they've been giving out high yields. Well, this is starting to fall apart. And when we start to see some bankruptcies now, we've seen a few, but when more start coming in, then the money will not be going to fund this drilling. On the other hand, Saudi Arabia is not, they can produce oil at 40, but their state government needs almost $100 to balance their budget. So I don't know. It's going to be interesting to see how this unfolds, but we already had a collapse of the Eagle Ford. According to the EIA's most recent productivity report, Kenneth, the Eagle Ford, which is the largest shale oil field in the U.S., according to their estimates for next month, it's going to be down 30% since peak in March. That's 500,000 barrels a day that they forecast will come off of that one U.S. field. So I think we're going to see larger production declines in the U.S., and it'll finally start making its way into global oil production following afterward.
So you brought up debt, and you actually pointed out to me, and I guess I understood this, but for each dollar that gets put in the system in debt, the economy grows so much, and it used to be a lot more than it is today. We're, again, going back to getting to the end of this monetary experiment. We're damned if we do, and damned if we don't, in terms of at least high oil prices, low oil prices. But you said we can go down to $20 a barrel. What does the economy look like at $20 a barrel oil, Steve?
Well, I think there's very few. Saudi Arabia might be able to produce old oil, their existing oil, at $20 or $30. Just produce it. Let's just forget about what it costs to maintain their state budgets. But I'm not saying that the price of oil will go to 20, but I think 2025 is what the world could afford before we started adding a lot of debt. And again, what happened was the oil price increased. We started seeing more inflation being driven throughout the system. Wage earners wages didn't keep up with it, so we just added more debt. And so now, I think we could see we could see high 20s. We're at 35 right now. We're only about $5 away from being at in the 20s. If it gets down that low, it's really going to impact the shale oil industry. And let's just forget for a minute. Let's forget about the rest of the world. The U.S. has to survive upon its own energy production, and the reason it's been able to import up to, at one time, 2/3 of its oil is we've been giving treasuries and paper, basically paper assets for real things. Well, I think in the future we're not going to be able to do that. So this is going to be a real problem. Russia produces 10 million barrels. They only consume about 3.5. They can export 2/3 of theirs. We only produce right now about half of ours, and that's going to fall off a cliff. So the U.S. is in serious trouble. And even though the Fed increased interest rates, I don't see this policy, this official policy, helping the fundamental problems we're going to face going forward.
Steve, one thing that we have talked about in the past, and you've talked about it in multiple interviews, but it's actually something that it's hard for people to wrap their mind around. I know for me, it took me some time, and I'm still trying to wrap my mind around it, but it's that energy is behind what grows the economy. And I want you just to explain that one more time for the audience. I think it's worth talking about how exactly it's tied to growth and how the economy is dependent on a growing energy supply.
Okay, I need to put this chart together. I don't have it. And I've been wanting to put it together. It's going to take a little time, but I'm going to just describe it to you. If we take a chart, goes back to, let's say, it goes back to 1000 AD, 1,000 years ago. And we look at population, we look at coal consumption, oil. There wasn't any oil consumption really back then. And we just plot this line. When it hits 1900, or let's say late 1800s, coal comes on. So we see, and then the population starts moving up. Well, in the 1900s, we get oil. The graph goes exponential. Not only population, silver production, copper production, gold production, all the productions of all metals and natural gas all goes exponential. Well, this is not something that's going to continue forever. And so the problem is we've been using energy, the increase of energy every year. It has been building up until about the 2005. We had an increase of a certain percentage of GDP of global oil production. Well, that 2% of global oil production increase that year allows us, the banks, to have a positive interest rate. That's when people used to have savings accounts, and they would pay you 3 or 4 or 5%. Now, where did they get that 3 or 4 or 5% from? It didn't come from the Wizard of Oz. It just didn't come out of thin air. There had to be economic growth to pay that interest. The bank had to have that growth. Where did the bank get that growth? From the energy supply. Growing. So now that the cheap energy has peaked, we have been seeing an increase of expensive energy that we really can't afford. We only can afford it when you add a lot of debt. So we've peaked in cheap energy, so you can't have a growing interest rate. You can't. Not a normal growing interest rate. I'm not talking about it loan shark or in small instances where you see higher rates for certain things. I'm talking about a huge rate for the whole market. You can't have a high interest rate or a normal interest rate. So what happens? The banks, the Fed and central banks start lowering rates because they cannot service the debt when it's a 5 or 6% rate. So that's why we've been seeing this lower interest rate happening with all the central banks. And it's funny that the Fed has raised rates. I don't think it's going to be a long-term solution. I don't see how they can, because they're going to have to print money to pay it.
Yeah. No, it's out of control. The the global system is a major mess at the moment. Steve, I want to ask you about the gold and oil, and you showed me a chart that basically shows oil compared to gold, and we're going to see a major divergence in the upcoming future in this chart, and I want you to explain it a little better than I did, and just basically show the significance of what we are going to see with oil and precious metals going forward.
The reason why I put this chart together, there's this technical analyst out there talking that the gold and silver bugs have been wrong for the last 4 years. Well, maybe that's true on the timing, but who knew that the Fed would create an accounting gimmick and put $2.5 trillion. They basically bought these mortgage-backed securities from the banks and paid them full price, and they're garbage. So they have this $2.5 trillion worth of reserves on their balance sheet that the large banks do, and it was basically a gift. Well, who knew? We didn't think they would do something like that. This is insane. This is psychotic financial economics 101. But I put this chart together. It's not, the price of gold is not based upon sentiment. It's not based upon a turning technical analysis. If you look at this chart, you could see from 1940 to 2015 how the price of oil and the price of gold moved. Some say this is just a coincidence. I don't think so, because I looked at the production figures for Homestake Mining, which was a big miner, one of the biggest gold miners in the U.S., and their production costs skyrocketed in the 1970s. So the price of gold had to increase to keep up with the cost of production. Well, if you look at the chart, you'll see from 1940 to 1970, flatline dead. Nothing happened. Both oil and gold didn't move much. Well, in 1970, things changed. Nixon dropped the gold peg, and the U.S. peaked in oil production in 1970. So we had two oil price shocks. One was in 73, which was the Arab oil embargo, and then we had the huge Iranian crisis, where they actually took off 75% of their oil production in a very short period of time. The price of oil jumped to $35 from $1.50 in 1971 to $35 in 1980. This pushed up the price of gold and silver because gold and silver are monetary metals. They're inflation hedge. Well, over the next 20 years, the price of oil and gold and silver declined, and they remained flat, or they kind of trended in a range bound. Well, it wasn't until 2004 we started seeing the price of oil really skyrocket, and it went from 25 up to 115 average in about 2011. So it wasn't a coincidence that silver and gold went up with the price of oil. Now, that being said, let me conclude here. That's how I saw the price of gold and silver moving. However, the future value of gold and silver will not be tied to the price of oil. It will be based upon the collapse of energy production due to its, we're no longer able to afford high oil prices, and we can't add a lot more debt in the future to bring on this oil, so we're going to see a collapse of oil production, and it's going to destroy the over $200 trillion in financial paper assets that derive their value on a growing economy which needs growing energy supply. So investors moving out of paper and into physical, and we're only talking 1 to 2%. We don't need 10% or 20%, even though I think that many are going to try to. All we would need is 1 to 2% move into gold and silver, and their prices will move in a direction that I think they're going to really skyrocket. So that's how I see it playing out over the next several years.
Steve, recently you put out a startling chart, actually, in your December 11th article, and it shows the cost for primary silver miners increasing incredibly just in the last 10 years. My question is, does the current silver spot price, is silver at the current spot price even more undervalued compared to mining costs that we saw in 2004 at $7 silver?
Yeah, well, if you look at this chart, and it's in my important silver key factors 3 must-see charts article. I showed 2 charts there, which show the 7 companies, their production and average yield. You see, things keep changing, which people need to realize, investors need to realize. Even though the price of oil is almost the same as it was in 2004, and in 2004 the price of silver was $6.67. Now it's about $14. So people think, well, the price can fall that low. Well, the top 7 primary silver mining companies, they are moving twice as much ore now. They were producing silver at 13 ounces a ton in 2005. Now it's down, first 3 quarters of this year, it's down to 7.4. It's almost a 50% decline. So they have to move more ore to produce the same silver. This is very expensive. And I've also included a Pan American Silver estimated break-even. Now, what was interesting, in 2004, they lost 10 cents an ounce, according to my estimated break-even. So even though the price of silver, Kenneth, was $6.67, they needed $6.77. Now, this grew. They actually made money from 2007 to 2012. They did make money. Well, over the last 3 years, they've been losing money. And according to my analysis, in the first 3 quarters of this year, their average price that Pan America got for their silver was $15.85, but they needed 97, almost $1 more. So they're losing $1 for every ounce. So the thing is, even if oil prices fall a little bit more, things have changed now, Kenneth, in 10 years. And they changed in 40 years when we were mining gold in the 70s and silver in the 70s. I would imagine the primary miners were mining silver at double, maybe 20 to 25 ounces per ton. So we continue to see lower ore grades, lower yields. It just costs more money. And cost-wise, I don't see the price of silver falling too much going forward. But this is what's going to happen when we start to see the collapse of oil production. That's the key to look at, is the energy. And unfortunately, most precious metal analysts do not factor in energy. And it's the most important factor to understand where the precious metals are going forward.
Steve, I know you're also an expert when it comes to just following the COMEX, and I wanted to ask you a couple questions about it. Basically, we've been very focused on the COMEX and the paper price expansion. We know there's a lot of manipulation that goes on. Not that long ago, we were 240 paper promises to 1 registered ounce. It quickly jumped to around 300 to 1, then 325 to 1. Now we're back down a little bit. I want to ask you, why are these numbers are significant and worth our attention, especially when you compare it to a historical context? I want to understand why these numbers are significant today.
Well, I think the COMEX has become a joke. And I think anybody who's out of Asia, India, look at what's happening, and they realize the COMEX is a joke, because you don't see much in the way of gold coming off of being delivered on the COMEX. But the Shanghai Gold Exchange, I think delivered 200 tons last month, and where the COMEX it's a few tons. It's a joke. And so what's happened is we've seen a huge decline in the registered category. I think it's a sign that shows whether it's 300 or 250 paper contracts to 1 ounce. It really doesn't matter anymore. I think it really, the COMEX is dead. Now, why I say that, and let me give you this information. The COMEX is kind of like the ETFs. Now, from 2006 to 2010, Kenneth, there was 61 million ounces went into global gold ETFs. Well, about 123 million went into gold bar and coin, physical. It was about double. Well, something changed in 2011. 2011 from 2015, on the same year period, we had a net drain of 21 million ounces of gold from global ETFs. Most of it was the GLD. A lot of it went to China and Asia. Well, the gold bar and coin demand skyrocketed to 208 million. So there's a big disconnect between global gold ETFs and actual physical gold bar and coin demand. But what's even more drastic is silver. Now, from 2006 to 2010, silver ETF net build was about 570 million ounces, and bar and coin was about 530. They were close. A little more went into the global silver ETFs. After 2011, what happened? We only saw 18 million ounces going into silver ETFs net for those years. We had 994 million ounces went into silver bar and coin demand globally. 1 billion ounces. It's the difference between the ETF and actual physical demand is astronomical. So that just tells me paper silver and paper gold markets are dying. And this is also with the COMEX, because the COMEX is not a real exchange, physical exchange market, delivery. It's more of a manipulation, paper manipulation, because the Shanghai Gold Exchange is delivering a lot of gold, where the COMEX is delivering very little. So I think what's going to happen in time, where you're going to see more, I think we're going to see continued drain of the GLD, and at some point in time, the COMEX just won't matter. I don't know if there'll be a default, Kenneth, but it just won't matter.
It just won't matter. So, would you say that the COMEX is where the majority of the fraud is? I mean, there's a lot of precious metals exchanges around the world, and this is just where we're seeing the most amount of fraud, because, and that's why our attention is focused at the COMEX.
Well, you know, Kurt Ferguson over at TF Metal Report made a great analogy. When you go and buy, let's say, a Rembrandt, there's only one of them. So the price was going to skyrocket because you can't increase that Rembrandt painting. Or let's say you buy a stock in a typical market. Well, there's only so many shares. Well, the price will go up. With the COMEX, they continue to add more contracts as the price increases. And these are short contracts. So there is no, that's the problem with the COMEX. The price cannot rise because we see continued increase in shares. So the shares are absorbing basically the price increase. And of course it's paper. So I think that's the difference with the COMEX, that actually is a market maker for gold and silver, but the rest of the world, the Asians, don't mind it. Because right now the price of gold is close to its production cost, and the price of silver is a little bit below its primary production cost. But again, that's a commodity pricing mechanism. That's not a store of value. And again, when gold and silver are competing with the 200 plus trillion of stocks and bonds, insurance funds, mutual funds, those are not assets. Those are energy IOUs. So the world hasn't figured that out yet. So I call the future of gold and silver Bear Stearns inverted.
Wow.
So we're going to see Bear Stearns go the opposite direction with the precious metals.
Steve, you've given us an amazing amount of information in about the last 30 minutes, and I wanted just to ask you, is there anything else that you had on your mind today that you wanted to share with our audience before we said goodbye?
Well, I'm glad we got to talk about the debt and how debt needs to be added to bring more energy on. And I spoke to a gentleman, I've been having conversations with him now for over a year. He's a president of his own oil company in Texas. He's been looking for oil for over 35 years. Actually knows Bunker Hunt. Bunker Hunt recently passed away, but he actually did dealings with Bunker Hunt. And he says they look for conventional oil, Kenneth. That's the real profitable oil. It's like return on investment is like 30, 40, 50 to 1. And energy return on investment is like 30, 40 to 1. And so these folks that he deals with in his business, and he knows just about everybody looking for oil in Texas, Oklahoma, and Louisiana. Knows all of them. He look for oil until the price of oil hit $60 or $65, and now it's 35. He says none of the folks he deals with goes after shale oil. It's insane. There's no money to be made there, and so there has never been really much money to be made in shale. But this is the thing I wanted to get to. There have been articles and talk about earthquakes in Oklahoma, and a lot of people think the earthquakes are from fracking. They're not. They're from re-injecting the wastewater that comes from fracking. And he says this has become a big issue now. It's very expensive to get rid of this wastewater, and as a well gets older, a shale well gets older, there's more water cut than there's oil. So it's even more expensive to get rid of this oil, wastewater oil. Well, I just saw an article. There's 2 lawsuits now by people who had damages from homes because of earthquakes, and they're suing oil companies.
Wow.
So how this plays out in the future, it's basically connect the dots. When you inject water in the ground, it messes up the geology, and so there's more earthquake activity. So I think this is just more stuff that we're going to have to deal with going forward. And I think this will be another nail in the coffin for U.S. oil production. And so I wanted to, I get to talk with some very interesting people in different fields, and I don't think we're prepared for what's coming, to tell you the truth. I think when the thing finally cracks, Kenneth, I don't think Americans in the world are prepared for what's coming. And so
the damage has been done, Steve, right?
Yeah,
the damage has been done. And now we're just dealing with it bursting at the seams. So, wow, what an excellent amount of information, Steve. I really want to thank you for coming on the show with me today. Anyone who wants to get more information on Steve's work, check out srsroccoreport.com. Steve, is there anything that you wanted to share with the audience as to some of your latest research or things that they can find at your site at srsroccoreport.com?
Sure. Well, I normally put out 2 to 3 articles a week on energy, precious metals, mining, and how the energy impacts all of these factors going forward. I wrote a report, a paid report called the Silver Chart Report, and it goes over the silver market and industry like no other report. And it's my first report. I'm working on a second report, but it gives investors, new and experienced investors, an excellent understanding with these charts, and they're all explained in one page of the silver market and why it's so undervalued. So if they want to come check out my site, I think there's plenty to read there, a lot of archived information, and I do appreciate your time with this interview.
Steve, thank you for your time, and we'll talk soon.
Okay, Kenneth, thank you.